Hey there, fellow accounting enthusiasts. Today we're going to talk about T accounts. I'm John, a CPA, and I'm going to break down T accounts so you have a really good understanding of them after this video. If you're new here to the channel, make sure you hit that like button, subscribe, and click the bell notification so you're updated on all the new videos I put out. Now grab your notebook and let's jump into T accounts. Okay, so what exactly are T accounts? They're a visual representation of the accounts, and they get their name from that distinct T shape. Generally speaking, you have your debits on the left side and your credits on the right side. You're going to have a beginning balance at the top, ending balance at the bottom. Through your T account, you're going to flow your debits and credits, transactions, and journal entries so that it takes you from your starting balance to your ending balance for the account. Woo! In a nutshell, that's really what a T account is, but I want to take a look at one. So let's dive over to an example, and I think it'll make a little bit more sense. So for all our examples, we're going to use a fictitious company called Busy Bee Bakery. I used to go there as a kid and get 50-cent donuts, but you can't do that anymore today. Let's assume we have $500 in a cash account to start. So what we're going to do is put the cash account heading at the very top of the T account. Below that, on the left side, we'll put our debits. On the right side, we'll put our credits. We're going to draw our visual representation with a line across the top and one down the middle to make a T shape. Now, generally speaking, I like to put a line at the bottom as well. That way, when the transactions are flowing in and out of the account, I can tally them up and get a total at the bottom. For $500 in our cash account, we're going to put it on the left side as cash has a debit balance. Now, it's something we looked at in our previous videos, which accounts have a debit and a credit. The best way to keep this straight is with the dealer mnemonic, and you can go back and watch the video on debits and credits. I think that's really going to help you keep the accounts straight and know which accounts receive a debit or a credit. All right, so we have our $500 in our cash account. We kind of know how to draw a T account here, which we're going to reinforce as we go on through these transactions. So let's move on to the first transaction. You're the owner and you buy an oven for $300 in cash. Now keep in mind that whenever you make a transaction, it needs to hit the same account or two accounts so that the accounting equation is always in balance. So for this first transaction where we buy an oven for $300 in cash, we're going to credit that cash account for $300. And you'll see that by making an entry to the right side of the T account. And then we're going to debit a corresponding equipment account for $300 as well. So you'll see that we're reducing the cash account by $300 with a credit, but we're increasing another asset account for $300, which is equipment. Now, just like our first example, to draw the equipment T account, we're going to make a line at the top, one down the middle to get a visual representation of the T. Now at the very top, we're going to put our account name, the left side debits, and the right side credits. Since there's no beginning balance in this one, our $300 debit will go on the left side. And if you were to take that to the very bottom and tally it up for now, you would have a debit balance in this asset account for $300. Now, if we jump back to the cash account, we had that initial balance of $500 for a debit. And since we're crediting $300 to pay for the equipment with cash, our running total would now be $200 in the cash account. Our second transaction gets a little bit trickier. We buy $50 of supplies on account. So when we buy on account, we're not touching supplies because we think of it almost as a credit card transaction or an account that we're going to pay later. So let's draw out two T accounts here. We're going to draw out one for supplies and we're going to draw out one for accounts payable as well. We'll do the titles at the very top of each account, debits and credits for both of these T accounts. Since we're buying $50 of supplies on accounts, we're going to credit accounts payable for $50 and we're going to debit supplies for $50. Now in this sense, we're increasing our assets, but we're also increasing our liabilities. So if we went back to the video on the basic accounting equation, you would see here that the transaction is keeping the basic accounting equation in balance. And there's also two sides to the transaction because we're hitting supplies and we're hitting accounts payable. Let's assume you've been baking all morning and now you're going to sell $100 of brownies to Speedy's accounting firm. It's mid-busy season, you know how it is, and they need to stock up that break room with some brownies to keep those accountants going and you guys working the long nights. So you go over there, you deliver the brownies to Speedy's accounting firm, and the guy gives you $100 in cash. How are you going to record that as the owner of Busy Bee Bakery? So first, I'm going to let you draw two T accounts. If you drew revenue and you drew cash, then you're on the right track. So we're going to credit revenue for $100 to increase the revenue account, but we're also going to debit cash for the cash that he handed over to you. That's going to increase the asset side of the basic accounting equation and also increase the cash account. Now let's take a look at our last example. We're in a pretty good spot as the owner of Busy Bee Bakery. We've just got our $100 for selling our brownies, but there's one more transaction we need to capture. And that's reducing supplies for the supplies used to make the brownies, but also capturing those costs of sales, which is associated with the brownies. So we need to draw two last T accounts here, but we already have our supplies T account. So if you remember from our previous example, we had a debit balance of $50 in supplies. In this example, we need to reduce that by $25. So if we had a running debit balance in the supplies account, which was an asset account, we need to credit it by $25. Now this should be pretty simple math, but to get to your running balance now, at the very bottom, supplies will have a $25 debit balance. And our other T account, which we haven't seen before, is cost of sales. Now this is a P&L account, which will show up on the P&L, and we don't have a balance in it yet. To increase cost of sales, we're going to debit it by the $25, and this is essentially the cost of those sales associated with the $100 of brownies sold. So on this last example, you'll see that again, we have a double-sided transaction. It remains balanced in the basic accounting equation. And you're using these visual representation of accounts, which are our T accounts, and it's able to help you track the transactions that are flowing in and out of the accounts. So we went over a lot there. Multiple accounts, different transactions, and we learned how to draw the T account, which is a visual representation of these accounts. You'll remember that T accounts are great for seeing transactions flow in and out of accounts. They'll really help you keep your debits and credits straight, and you'll be able to see the running total and balance in your accounts. As you move further and further in accounting, transactions get more and more complex. You still might fall back on T accounts and use them as this visual representation for the accounts. Now, these transactions, they're something you might see in a basic accounting college class or accounting 101 class. So if you were getting stuck on any of these, feel free to go back and work through them again. Make sure you hit that like button, subscribe, and I'll see you in the next accounting video.